Tension in the Strait of Hormuz and the operations launched against Iran have sent markets scrambling for safe haven. So, how is this chaos going to impact your portfolio? Welcome back. If you've been watching the news over the past week, you already know the world just changed. U.S. and Israeli forces launched massive strikes on Iran starting February 28, 2026. Nuclear sites, air defenses, missile infrastructure, even key leadership was eliminated. And markets? They are responding exactly the way they always do when the world catches fire. Today, we're breaking down two assets you absolutely need to understand right now. Gold and the S&P 500, where they're heading, and what smart investors are doing about it. Let's get into it. On February 28, 2026, coordinated U.S.-Israeli strikes began targeting Iran's nuclear program, its air defense systems, and its naval vessels in and around the Persian Gulf. Operations are still ongoing. Embassies across the region have been evacuated, and the geopolitical shockwave from this conflict is being felt in every single financial market on the planet. Here's why this matters economically, and it starts with oil. Oil prices spiked between 6 and 9% almost immediately, jumping to somewhere between $77 and $85 per barrel. Why? Because any conflict near the Strait of Hormuz raises the nightmare scenario. A blocked shipping lane that carries roughly 20% of the world's oil supply. That oil price surge isn't just a number. It's a signal of inflation, of slower growth, and of economic pressure building beneath the surface. And smart money knows exactly where to run when that happens. Let's talk gold, because the move here has been extraordinary. In the hours immediately following the initial strikes, gold surged by more than $200 per ounce. We went from around $5,100 to over $5,300, essentially overnight. Year to date, gold is already up 22%, 22%, and analysts aren't done yet. If this conflict escalates further, and current signals suggest it will, price targets of $5,500 to $6,000 per ounce are being thrown around by serious market forecasters. Why is gold doing this? 3 reasons. Number 1, safe haven demand. When geopolitical risk spikes, money flows out of risky assets and into gold. Number 2, inflation fears. War is inflationary. Oil prices rise, supply chains are disrupted, and government spending increases. Gold has historically been the best hedge against exactly this kind of inflation. And number 3, dollar volatility. When currency markets get shaky, gold becomes even more attractive as a store of value. Now let's talk about stocks, and this is where it gets more nuanced. The S&P 500's reaction wasn't a straight line down. In fact, on March 2nd, the index actually gained 0.2%, even as the conflict was escalating. Why? Tech and AI optimism. Markets were still pricing in strong earnings momentum from the AI sector. But then, reality set in. By March 4th and 5th, the S&P fell between 0.56 and 0.6%. The Dow dropped roughly 800 points. The culprit? Oil prices climbing further, stoking fears of an economic slowdown. Here's the historical context you need to hear. Geopolitical shocks, wars, strikes, crises have historically had limited long-term impact on stock markets, unless the oil disruption becomes severe and sustained. That's the key phrase. Unless the oil disruption broadens. If the Strait of Hormuz gets seriously disrupted, that changes everything. Let me give you a clean summary of what's driving each market right now. First, the oil surge. For gold, it boosts the inflation hedge narrative. For the S&P 500, it raises recession fears. Second, safe haven flows. For gold, strong, consistent gains. For the S&P 500, risk-off selling pressure. And third, the policy outlook. The Fed may be reluctant to raise rates aggressively while a war is happening. That's bullish for gold, while tech resilience is partially offsetting the macro headwinds for the S&P. So what does all of this mean for you, the investor watching this right now? First, don't panic. History shows that geopolitical events rarely derail long-term bull markets permanently. What they do create is short-term volatility. Second, consider your gold exposure. If you have zero allocation to gold, this conflict is a reminder of why that's a gap in your portfolio. Third, watch oil closely. If crude breaks above $90 or $100 a barrel and stays there, expect more equity pain. Fourth, tech isn't immune, but it's more insulated. Companies with strong AI tailwinds are holding up better than energy-dependent names. And fifth, stay informed. This situation is moving fast. The U.S.-Iran conflict is a live, evolving situation, and its impact on markets is far from over. Gold is surging, stocks are volatile, oil is a wild card, and smart investors are repositioning right now. If this video helped you understand what's happening, hit that like button, subscribe if you haven't already, and drop a comment below. Are you buying gold right now or staying in cash? I read every single reply. I'll see you in the next one. Disclaimer. This video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making investment decisions.